Sawadee krap, and good afternoon to our audience in Asia, as well as good morning to our audience viewing from Europe and the Americas. And welcome to the SET Digital Roadshow featuring today Central PATTANA Public Company Limited, or better known as CPN. This occasion will take the opportunity to just briefly give you a status update about our company, as well as the updates to our business strategy and going forward, recap on what's going on in 2018, as well as the look forward into 2019. So first of all, we'll give you a brief company overview again, just to reintroduce who we are, and then we'll go over the key achievements in 2018, as well as the financial results, as well as the company updates on various projects, as well as the company strategy. So just to recap, CPN is the largest retail property developer in Thailand. We're also amongst the largest companies listed on the Stock Exchange of Thailand as well. We currently operate in 32 shopping malls in Thailand. So we have approximately 1.7 million square meters of net leasable retail area. So by far the largest in the industry in the country, which amongst the 32 locations that we operate, we attract more than 1.3 million visitors per day. So perhaps one of the, if not the only, shopping mall that's very popular here in Thailand. Well known amongst the locals and as well as the tourists. Our shopping malls also boast a very strong performance throughout the year. At the end of the year, we average, through our 32 locations at about 93% occupancy rate. So it's proven to be a very high and sustainable rate of occupancies to sustain our business. Within our portfolio investments, we also invest in CPN REIT, one of the REITs that's also the largest on the Stock Exchange of Thailand as well as CPN Commercial Growth Leasehold Property Fund, of which we own 27 and 25% respectively. Last but not least, we are proud to say that we are the only Thai real estate company that's listed on the DJSI in 2018 in 2 indices. So there's one in DJSI World and a second in DJSI Emerging Markets for the 5th consecutive year. And just to recap on our past performance, through the past decade, I think we've consistently achieved double-digit revenue growth. So this is something that we're very proud of, especially as one of the largest companies here in Thailand. Just giving an overview of our shareholding structure, we're primarily owned by the Central Group of companies, who has over 70 years of experience in the retail and commerce industry. So CPN acts as a property development and management arm of Central Group, who develops the shopping malls, which goes by the name of Central World, Central Plaza, Central Festival, and the latest development that we delivered last year was Central Phuket. So amongst all these flagship shopping malls, we also present a complete range of products and service through well-known brands under the Central Group, whether it come from the department stores, the food retail specialties, the food restaurant groups, as well as the marketing groups, which, amongst other business units under Central Group, we also achieve similar synergy, as well as being able to leverage the Central Group brands to basically increase our attractiveness at the mall locations that we operate. So moving on to the 2018 key highlights for the year. So I guess we can sum up to 4 different categories. First of all is we continue to deliver a strong record of retail footprint expansion. So last year we delivered a new mall, which is an additional wing across one of the existing malls that we have in Phuket, which is called Central Phuket Florista. It's right the opposite of the other existing wing called Festival. So both these 2 buildings henceforth will be called Central Phuket, which is by far the largest shopping mall in southern Thailand. So we launched the Florista wing by I think September last year. So it's proven to be an extremely popular destination for both locals and tourists. And that location within 2019 will continue to deliver other strong attractions, plus new varieties and categories of well-known brands as well. Second of all, we continue to deliver a strong alliance with our business partners, mainly on the opening of IKEA Bang Yai, which is next to our flagship regional mall, Central Plaza Westgate, back in March last year. So that has proven to be an all-new format for IKEA, which basically integrates the store with all the floors in the shopping mall section. So it's a brand new format for IKEA, very exciting, very promising, and as well as being able to attract an additional group of traffic and visitors who comes to not only to IKEA themselves, but are able to enjoy a complete lifestyle offers within the Central Plaza Westgate shopping mall. So I think as a result of this partnership, we're able to enjoy a consistently increasing traffic into the mall, as well as a consistently high occupancy rate and increases in the rental rate throughout the year. Another joint venture development goes along with the new business line in the co-working space, which we also announced the agreement with Common Grounds Group from Malaysia, which in the future we plan to launch the co-working space business line in the future. So this is something that we're very excited on. The prospect to be able to further integrate the utilization of the shopping mall area and the office building area. And co-working space is something that's proven to be very popular and with increasing demand here in Thailand through the years to come. So this is something that we're also excited to bring on board. Another, let's say, headline for last year was the acquisition of Grand Canal Land Public Company Limited, or better known as G-Land, which we ultimately own 67.5% share of G-Land through the acquisition last year, which we paid for approximately 13.6 billion baht to acquire those shares. G-Land, just to summarize a long story short, is one of the property developers listed on the Stock Exchange of Thailand as well. Their key assets are primarily located in two areas, both in Bangkok, both in what we call extremely prime areas of Bangkok, where the CBD expansion will spread throughout in the future, one in Rama 9, and the other in the area called Pahon Yotin. Those are two land areas that CPN is eyeing on a very extremely high potential cases of mixed-use development in the future. So from the acquisition of G-Land, I think we're able to bring on board two very valuable pieces of assets that we see the potential to bring the value further up going forward. Last but not least, we're just to recap on the achievement on sustainable development. We're once again listed on DJSI for the 5th year consecutively on the DJSI emerging markets, as well as the first year to be inaugurated into the DJSI world. This is a summary of our 2018 financial performance. So through 32 shopping malls, 1.7 square meters of net leasable area with an average of 93% occupancy rate throughout the malls. And last but not least, these all translate, not only from the growth from the shopping mall business, but also contributions from elsewhere, such as the food and beverage revenues, the hotel business, and the all-new residential development revenues that we start to realize the income for the first time this year, which altogether brings us to a total top-line growth of 17% compared to the year before. So altogether, a very solid performance. I think, and underlying this growth is also a very solid same-store mall performance with an rental revenue growth of about 3% versus the previous year. So I think for the full year results, we're not going to go too deep into it, but just to underline the key performance is that we're able to deliver the growth that we set up from the beginning, which is first of all, continue to deliver the performance of the new malls, especially those that we launched in the past couple of years. Second is that we start to see increased contributions for the malls that we've undergone renovations during the past year, such as Central World, as well as Central Plaza, Rama 3, which by the end of last year, we're starting to see very encouraging signs of improved performance, both in terms of occupancy rate as well as rental rate reversions. Thirdly, we want to be able to leverage the operating costs as well as the SG&A expenses to the suitable level under the current operational environment, which, by noticing the numbers from the revenues down to the bottom line, is that the expenses have increased quite a bit, and this is down to a few anomalies. First of all, last year we had an ongoing renovation for the major parts of the U.S. Central World, so that in a way had suppressed the level of our normal operating margins quite a bit, which we don't believe that that's going to be an issue for 2019, as Central World is now back to almost full operations for a time being. Second of all, based on the SG&A ratio to revenues, we've seen a slight increase over the past year as well. So right now, compared to our total revenues, the SG&A expenses is up to about 17%. This is a level that we believe that in the short run, we'll see a similar trend of SG&A to revenue ratio. But as soon as we're able to deliver the future business plan, such as going more into mixed use, going more international, we'll be able to see better leverage of these expenses, so the ratio should come down in the future. And last but not least is the renewal of the land lease at Central Plaza Rama 2, which we were able to successfully secure a 30-year extension pretty much several years ahead of time before the land prices, since it's on an increasing trend, you were able to lock down the agreement quite early before we let the old contract expire. In accounting practices, this in a way affected our cost of rental and services business in the fact that we have to incur an increased cost base for this Rama 2 mall, which lowers our overall gross profit margin by roughly about almost 1.5% last year. So this is something that once we've extended the terms with the landlord, we'll bring the new terms to extend the leasehold contract with CPN Reed, who is currently the leasehold the lessee of the Rama 2 shopping mall. So that's going to take place over the next 12 months. So we'll be able to get better clarity in terms of the contract extension on that front, which, if successful, will be able to uplift our revenues proportionately with the increase in expense. And last but not least, last year we had a conversion of CPN RF property fund into CPN Reed. So we're able to have an incremental increase in other income, such as the management fee of CPN Reed. Together with the REIT's larger asset base, since by the end of 2017, we were able to transfer 2 additional assets into the REIT. One is Central Festival Pattaya Beach, and the other is Hilton Pattaya Hotel. So to summarize our operating performance, we have 32 shopping mall locations, 14 in Bangkok and 18 in the provinces. And in terms of the area split by Bangkok and provinces, it's 52% to 48% respectively. In terms of revenue, it's 59% Bangkok and 41% in the provinces. And all of these malls, the average, the occupancy rate averaged at above 90%, which is consistent with our mall performance during the past year as well. We also have other non-core properties, such as residential building for sale, for lease, as well as office buildings at 7 locations next to our shopping malls, plus 2 hotels in the provinces too. So all of these assets still posted a similar performance as we did, in the year before, and as well as throughout the year. This is the track record of our revenues and profitability growth in the past 5 years or so. So I think we're able to consistently deliver approximately double-digit or close to double-digit top-line growth, as well as in terms of the same-store rental revenue growth performance. We're able to achieve consistently close to what we've guided, which is around 3 to 4% in 2018. So this is something that we believe could be continued or maintained going forward in the years to come. And of course, our revenue structure, the majority of which, comes from our rental and service business. So this has exhibited quite a solid growth to begin with. But the protagonist of 2018 was the recognition of the residential development for sale, which has made up about almost 8% of our total revenues for the year. So we were able to complete 3 projects within 2018, which are the condominium projects next to our shopping malls. So these have been, proven to be very popular. All sold out back in 2016 when we first launched, and now that we've completed them, we've also be able to transfer the majority of those units to our customers. So this has been a key boost to our revenue growth for 2018. As well as on the cost side, like we mentioned, excluding all the anomalies that happened to our base business, I think we're able to achieve probably incremental efficiencies to our core business during the year, especially in the utility cost savings, which we were able to realize some efficiency gains, mainly from like the utility unit savings from the electricity units consumed at our malls. Last year, we had a full-scale implementation of LED lighting through our 32 shopping mall locations, as well as the implementation of solar rooftop panels at several of the locations as well. So this has contributed to approximately 1 to 2%, units savings in terms of electricity consumption, which compared to the electricity rate that, back in 2018, it was on the rising end. I think we're able to sustain a pretty, close to flat utility cost increase in 2018. So despite all the external cost pressure, I think we're able to maintain a fairly efficient level of operation so far. As well as SG&A. 2 of the key components under SG&A are personnel costs and also marketing expenses. As for personnel, as mentioned earlier, we're in the middle of the business expansion plan into both asset type diversification as well as geographical expansion. So we were on the verge of increasing our organization to support those new businesses as well. Once those businesses come online in the years to come, we'll be able to see better economies of scale from all these additional costs that we're holding up at the moment. So we would expect that the trend for SG&A to revenue ratio to come down in the future. Marketing expenses, of course, we had a pretty active year at our malls, especially with the new location in Phuket, the resumption of Central World, as well as generally increased level of activities at the other malls as well. So we've had a pretty active year in terms of the marketing front. So that contributed to the marketing cost increase. But in terms of the cost components, I think it's fairly stable compared to the year before, which is roughly around 20% of the total SG&A. We also had a couple of new SG&A items, such as the rental expenses that we pay to REIT for the sublet right of the Hilton Pattaya Hotel, which, according to the SPV agreement, we have to pay REIT at with a relatively fixed cost for the use of the Hilton Pattaya Hotel under that arrangement, as well as other costs associated with the transfers of the residential projects and the cost on the acquisition of G-Land shares. Looking at our net breakdown, we're last year we've had quite a bit of increased activities on the capital structure side. So I think it's primarily driven by the fact that we went through a G-Land acquisition transaction, plus the inclusion of G-Land's debt as a result of G-Land becoming one of our subsidiaries. So altogether, I think we saw a general increase in terms of the financing cost by about 17% versus last year. And the overall debt, I think we're fairly even between short-term and long-term, which is about 1/3 and 2/3 of those respectively. Plus, in terms of the fixed and floating rate exposure, is about 50-50%. Nonetheless, we still maintain a very strong credit rating within CPN, as well as a stable outlook. So in terms of the in terms of the capital structure management, I think we're going to look to reduce these costs of debt going forward, such as restructuring some of GLand's loan, as well as refinancing some of our loans to get a better or more attractive rates. So from that, I think we saw a general increase in terms of the gearing. So our net debt to equity ratio went up to about 0.4 times by the end of 2018 compared to the year before. I think we were under 1 time. So that pretty much came from GLand. But going forward, I think we still maintain a relatively flexible structure versus our internal policy level of no more than 1 time net debt to equity. So we still got a little bit of debt headroom left to support our investment plan. We had a board of directors resolution to propose a dividend payment of 1.1 baht per share earlier this year. So this is going to be brought to the shareholders meeting at the AGM next month. So we've already had an ex-dividend signed last week, and the payment day will be on the 7th of May. So this is consistent with our dividend policy of about 40% or more of the net profit. In terms of our rental contract structure, no major changes on that front. We're still dominantly under the fixed rent term, which makes up almost half of our total rental contract structure. The other is the consignment, or based on a percentage of sales, which some of those contracts we also have a minimum guarantee to basically hedge the downside risk. And last but not least, we have a long-term lease that's still, that's going to expire in the years to come of about 17%, which is, a similar ratio from the year before. So in the next 3 years, we believe that up to about 30 to 40% of these contracts will expire, which presents the room for us to be able to negotiate a new rate. In terms of our business update, we've had announced 3 new malls that will be delivered in the next 12 months or so. So this is something that we've consistently communicated during the past several months. Which by this year, I think we're quite excited to be able to deliver one of our first international project in Malaysia. The soft opening will be done by later this week, when the grand opening will be done by next month. So this is something that we're very excited on the prospects of being able to expand our presence outside of Thailand. The other location is called Central Village, which is going to be the first international luxury outlet mall in Thailand. So this is scheduled to open by the 3rd quarter of this year. And last but not least, we also have Central Plaza Eta, which is going to be the new lifestyle center in the northern ancient capital of Thailand, scheduled to be opened by early 2020. Central iCity, I think this is something that we've spent the past few years taking on tireless efforts to be able to deliver this project, and especially being the first project outside of Thailand. I think we've gone through quite a lot of the learning curves to understand the operating and regulatory differences between both Thailand and Malaysia. But I think it's finally reached a stage where we were able to achieve all the government approvals to launch this project. So right now, the guys in the leasing team and the property development team, working flat out at this location to be able to, launch in time of the soft opening later this week. So we've had, a pretty good run for iCity since the beginning of the year. So no major stumbles there this time. And of course, this is something that's located outside the busy city area of Kuala Lumpur. So it's in a city called Shah Alam, just 30 minutes southwest of KL, which is going to be another prospective location for this new mall. Just give you a glimpse of the progress of iCity since the end of last year. So, in terms of the construction progress, it's by now complete, and we're in the middle of the shop fit outs by the tenants as we speak. So we'll be in time to open later this week. Central Village is something that we're also quite excited on. Not only that's going to be the all-new format that we're going to deliver, the first of its kind in Thailand, but also, in terms of the progress, I think we're quite on schedule. In fact, in terms of the construction progress, I think it's pretty much, spot on for the 3rd quarter opening. In terms of the leasing progress, we were able to bring quite a number of brands on board. I think our pre-leasing progress right now stands at about 50%. So we're able to secure some of the brands that we've had them in the portfolio in the past, plus a handful of new ones, plus a number of luxury brands that could potentially open at this location as well. And just to underline the key advantage of this format is that, first of all, it's very close to the Suvarnabhumi Airport, less than 10 minutes to commute from there, as well as quite easily accessible from Bangkok downtown, as well as the nearby provinces in the east. And of course, we're going to have over 2,000 brands to join our project here in the end. So it's going to appeal to a large variety groups of customers. And last but not least, we still have room for future development for other types of properties like the hotel to be developed in that location. Central Plaza Eta, needless to say, it's going to be a Leave Lifestyle Center that's not going to support the local crowds, but as well as the tourists who in Ayutthaya, it's something that's going to be become a new emerging tourist destination going forward. So this is something that we want to incorporate a complete range of service offering to both crowds by 2020. In terms of delivering new attractions, last year we launched Central Phuket, and at that location, we're very excited to bring forth two very key destinations. First is Stripe Pool, which is going to be the first of its kind. It's a three-dimensional theme park walkthrough experience. We've launched this attraction back in February this year, so it's something that we're quite excited on the prospect in terms of becoming a global tourist destination to be able to enjoy the ancient Thai folklore presented in using new technologies and innovation as well. So this is something that we hope to gain more popularity going forward, as well as the new aquarium called Aquaria, scheduled to be opened by next quarter. So this is something that will be not only one of the largest aquariums here in Thailand or maybe even Southeast Asia, but it's going to feature over 25,000 different aquatic species. So it's something that we're going to make this a global attraction, another global attraction per se. In terms of the asset enhancement initiatives, last year the theme was around Central World, which we spent basically the majority of 2018 trying to complete the renovation program, which we did for the major parts. So all that's left now is to make a few touch-ups here and there to make the entire renovation program complete. So that's going to happen later in the months to come. And we're currently in the process of renovating, having two major renovations at Chiang Rai and Chonburi. So these will gradually be complete and delivered through the second and third quarters, as well as some minor renovations back at Central Phuket Festival, as well as at Central Lat Phrao and Central Festival Pattaya Beach. In terms of the residential development, so far we've launched 8 residential projects, seven of which is based on a high-rise project, condominiums. 6 of those 7 are located next to our shopping malls, primarily in the provinces, which is something that has proven to be a magnet for a lot of customers that by having a residential unit next to our shopping malls, it provides it's not only located in the prime location but also provides a lot of convenience in terms of addressing to the lifestyle needs. So we've had quite a successful run in terms of launching all these projects, and those were met with very strong demand. We also have one other project located in Bangkok, and this is something that even though it's not next to the shopping mall, it's in close proximity to one of our shopping malls at Lat Phrao. This is located in Pahon Yotin Soy 34, called Phil Pahon 34. It's right next to one of the SkyTrain stations, Senanikom Green Extension Line. So this is something that we've launched the pre-sale period last year, and we'll continually see the demand increase throughout the year, as well as continue with the construction progress, which we expect to complete the construction by the end of this year. The other project is a low-rise, our first low-rise project in the Brom Ratchathani Road, which is one of the major roads that that runs through the western part of Bangkok. And this is something that we're quite excited on delivering. The first batch of the Niyam project, which is a single detached housing project in that area. It's very conveniently located, right next to the main roads as well as the elevated road on that Brom Ratchathani segment as well. So by 2019, I think we'll gradually see a continuous delivery of phases of these single house projects, as well as continuously increase demand to serve this project. So going forward, I think we're looking at a magnitude of at least 3 new projects per year for the residential. In terms of G-Land portfolio, and this is something that, since our acquisition, we've also kept a very close eye in terms of its performance. G-Land currently has 3 operational office buildings. 2 of those have already been transferred into their REIT, so they still have the G Tower office building under their portfolio. All these 3 office buildings posted a very strong, occupancy rate for the office building area, average around 96%. They also have the residential units at Bill Grand Rama 9, which by the end of last year, they still have about 41 units remaining to be transferred. So in 2019 and in the following year, I think we'll be able to realize some of those incremental residential revenue transfers. In terms of all these properties, they also have a retail podium area, which is not all that large, and at the same time still has room for improvement in terms of both the occupancy rate and the average rental rates. So we'll be looking to in the near term improve the performance of the of those assets. Plus the 2 locations that we mentioned, one at Rama 9 and the other one at Pahon Yotin. These 2 are very prime locations, which we're currently studying the development concepts to deliver a relatively sizable mixed-use development project in those locations. They also have a few other land banks, probably more suitable for standalone residential development towards the northern part of Bangkok. And so to underline, what's going to happen to CPN in the next 5 years, I think we're looking at a growth of 13% per year, and it's going to come from a few key drivers, but mainly revolve around, first of all, new business expansion. We're planning to launch 2 to 3 new shopping malls per year, primarily in Thailand. We still look at Thailand as something that's a key growth driver to our business, with still room for the market to grow. Second of all, apart from delivering new projects, I think we're looking at to continue to enhance the performance of our existing projects through renovations, through asset enhancement programs and such. And last but not least, I think we'll be looking for more and more contributions from the mixed-use development, not only in the residential projects. We also study other types of property formats like office buildings and hotels to complement with our core business. I think if we look beyond the next 5 years, the ability to maintain double-digit growth will be more challenging as our base business gets bigger in Thailand. That's why we start to look, for other sources outside Thailand to become, the key, long-term, growth driver for our business. And that's why we start to look into other promising areas like within Southeast Asia. We began the investments in Malaysia a few years back, and now we're also looking to Vietnam, which is something that we're quite excited on the prospects in the long term. And of course, Vietnam, without saying, I think first, not only that it stands out as the high growth country amongst the ASEAN countries, but in terms of penetration, I think we're looking at a relatively low penetration for the retail space in Vietnam. If we compare the major cities in Vietnam versus other major cities in Southeast Asia, I think there's still several folds, for Vietnam to be able to increase its retail density per population in there. So something that we're quite excited. And last but not least, I think if we look at the Central Group presence in Vietnam, through a very strong range of brands, such as Big C, which right now has been rebranded to Go, as well as a handful of other fashion brands, as well as food and other specialty brands as well. I think we can leverage the strong network from the Central Group to be able to deliver a similar success that we did in Thailand into Vietnam. So Vietnam is something that we're currently working on a few projects at the moment, and in the future we'll slowly be able to disclose additional information in terms of the investment plan. So to underline 2019, what we would expect through the year is, we still aim for another strong year, nonetheless, from all of our businesses, which is going to altogether contribute to another year of double-digit growth. I think we're looking at two main factors. One is, a sustained, strong performance from the core business, in the rental and services, which, we are not only that we're able to deliver, the new and renovated malls, and be able to sustain the performance of the existing malls as well. We also have a little bit of incremental contribution from G-Land, which, before this year, we'll be able to realize a full year contribution from that. Plus, other types of non-core businesses like the F&B, hotels, and residential will continue to pose a strong growth for us. And also in terms of profitability, I think we're looking to sustain the level of profitability margin for all of our businesses by being able to continue to capture additional efficiencies through our operations in both the core and non-core businesses. In terms of the SG&A to revenue, I think we're looking at a range similar to last year. And like I said earlier, that this is expected to be, in the short term. In the future, I think once we expand our business, I think we'll be able to appreciate the economies of scales from these costs going forward. This year, we plan to spend almost 20 billion baht of capex in terms of developing new malls, renovate existing malls, as well as in other mixed-use development, like in residential and hotels. So this is something that will be primarily supported by our strong operating cash flow base. Plus, we still have a little bit of room to gear up, our debt as well, since we still have a threshold of no more than one time to our internal policy. And so what this translates is that, we still believe that, having the same dividend payout policy of around 40% is still, a comfortable level that we have at the moment. And of course, on the sustainability front, we still aim to remain listed on the DJSI, as well as maintain an excellent rating to our corporate governance rating. So that's all for the presentation, and I'll be heading over to the Q&A, which the first question comes from. The first question is related to the potential increase in dividend payout, which, first of all, I think we'll be looking at them case by case. In terms of the policy, I think we're quite comfortable with the current policy at 40% of net profit at the moment. But in reality, I think we also consider other factors, like, for example, the capital needs for CPN, as well as the liquidity level that we have at that moment, to be able to consider probably a slightly higher payout than usual. We've had an instance back in 2017 where we recognized a non-recurring gain from the insurance claim at about 3.5 billion baht, which after we received that amount, we pay a portion of that back to the shareholders. So that year, our dividend payout ratio stood at about 46%, which was above our policy level. In terms of the gross margin between the shopping mall business and the residential development, I think we're looking at a somewhat higher margin, of course, for the rental and service business. Currently, our average gross profit margin, for the entire portfolio stands at around 48%, and within that, we've had, a portion dedicated to the residential development, which last year we were able to capture at around 43% gross profit margin, and just to compare with what we had versus what we forecasted, I think we were able to deliver an above expectation performance. We originally anticipated that we might be able to achieve around 37-38% gross profit margin for the residential business next to our shopping mall, which is basically developed on the piece of land that we already have. if we develop, say, on a new piece of land valued at market today, I think we might be looking at a gross profit margin of around 32%. I think in terms of the mix between residential and our core business and shopping mall going forward, we're still primarily driven by the shopping mall business, which the gross profit margin stands at about 50%. So it's going to be a very incremental change in the years to come if once we're able to see additional contributions from not only residential but as well as from offices and hotel as well. But in fact, the overall picture will not materially change from what we see today. In terms of the our expansion plan for new shopping malls, which we plan to deliver 2 to 3 new malls per year in the next 5 years, I think we're looking at an average increase in net leasable area of about 6 to 7% per year. If we separate that into like the next 3 years and also as well as between the next 3 years versus the next 5 years, I think we're looking at a low end of the increase during the next 3 years, because in the pipeline, we plan to expand first of all, domestically. The area won't be a large incremental versus the base that we have. But by 2022, 2023, I think we're looking at the major delivery of the new projects, primarily within the mixed-use development space. The first one is going to be the Dusitani joint venture that we announced the agreement with Dusitani PLC a couple of years ago, which we will basically redevelop the iconic Dusitani Hotel in the Bangkok downtown to become a new mixed-use development, which is going to have a hotel, shopping mall, an office building, and a residential unit. So this will be redeveloped until I think we're looking at a time frame of around 2023, 2024 for the launch of these projects. So this will be a relatively large increment to our existing net leasable area base. The second one is going to come from the G-Land, revisited development plan. First of all, I think we're looking at the space at Rama 9, which originally for G-Land was supposed to be the location for the super tower. And I think we're taking the time to revisit, the development plan of that particular project to basically, at the end, we want to be able to deliver a high value and something that synergizes the surrounding assets that we have. We already have a handful of office buildings as well as a shopping mall. So we're looking at a suitable mixed-use project that's going to add quite a scalable amount of area by that time. And plus, in terms of international contribution, I think we might be looking at the contributions from Vietnam by the tail end of that 5-year span. So that's going to be another factor that comes into play for the total area increase. We have a question regarding the goals from our collaboration between IKEA and Central Plaza Westgate. I think in general, we want to look for partners who have share a similar DNA for us. Is that we want to be able to deliver something new, of a new experience, a new format, one of a kind, unique offering, within our properties. So for this example, at Central Plaza Westgate is the new format that from IKEA, which is basically one of the leading global furniture flagships for them. And of course, by taking on new store format, which basically integrates all the entries and exits at the shopping mall, I think we're looking at launching a new phenomenon in terms of having one of a kind furniture attraction / lifestyle destinations within one location. And that's basically to serve the local crowd towards the northwestern part of Bangkok, which is an increasing market within that catchment. We saw quite a substantial increase in terms of foot traffic into the mall right after the launch. I think it's in the range of around 15 or 20% increase in traffic within the month of launch. So overall, I think we're seeing a general positive feedback to be able to deliver this all new format. I guess I guess the types of customers who come to visit at IKEA, I think they would find intriguing that it's located within the space where they're able to find other types of lifestyle attractions too. So if say the groups of target customers would go to IKEA to shop for furnitures or home solution needs, I think they'll find Central Plaza Westgate is something that could also fulfill other types of lifestyle needs as well, such as if they bring a family, we also have a family destination in that area. If they want to find other fashionable brands to fill up their closet or wardrobe and home, they can also come into the Central Plaza Westgate shopping mall to fulfill that need. So I think we're looking at a more dynamic solution in terms of answering to various customer styles and preferences, rather than just looking at hardline targets alone. And I think so far we've had a very strong positive feedback from this new format. So I guess that's all for today, and thank you very much. If you have any questions, please feel free to contact our investor relations team. Thank you. สวัสดีครับ